Let's begin by talking about assets. Assets are items of value owned by a business, such as cash, a company car, computer equipment, and if customers owe the business money, that's an asset too. That's called an accounts receivable. Now, in accounting, it's important to understand the claims on a business's assets or the ownership of the assets. When amounts are borrowed by a business, liabilities arise, and these represent creditor claims on a business's assets. And a creditor, of course, is someone or an organization that you owe money to. Equity represents an owner's claims on the business's assets. And we can express these claims on a business's assets by using what's called the accounting equation. In the accounting equation, total assets owned by a business, they're equal to liabilities plus equity. And again, remember, equity represents the business owner's claims to the business's assets. We can also rearrange the accounting equation this way to say that assets minus liabilities equals equity. And this is easier to understand if we think about a house. If you buy a $250,000 house, then you have a $250,000 asset. If you borrow $200,000 from the bank to purchase the house, that mortgage represents a liability. So the $250,000 asset minus the $200,000 mortgage equals your $50,000 of equity in that home. Now let's switch examples to a lawn mowing business. We're going to look at a number of transactions to see how they affect the accounting equation. And let's start by saying the business owner borrowed $1,000 from the bank to get the business started. So the business then has $1,000 in assets, since the cash that was borrowed represents an asset. The business also has $1,000 liability, the amount owed to the bank, the creditor. And you can see after this transaction that the accounting equation still remains in balance. Now let's say the business owner mowed somebody's lawn and received $50 in cash from the customer. This amount is revenue for the business. Revenues are assets coming into the business from providing goods and or services. And what's important to understand is that revenues increase equity. Therefore, if we look at the impact on the accounting equation, we can see that assets increased by $50 because of the receipt of cash. In addition, equity increased by $50. Now let's say that the business owner mowed a second customer's lawn and earned another $50 in revenue. Equity will increase again by $50, but this time the business owner did not receive cash. However, the customer does owe the business owner $50 for his services, and he would invoice the customer for this amount, and that accounts receivable still represents an asset. So we're going to have an increase in assets again. Now let's talk about expenses. Expenses are sacrifices made to earn revenue, and expenses decrease equity. So if the business owner puts $25 of gas in his tank on the way to mowing someone's lawn, that represents an expense. If he pays cash, then assets will decrease by $25 and equity will decrease by $25 because, again, expenses decrease equity. Let's look at one more expense example. Let's say the business owner purchases $5 in oil for his lawnmower, but this time he puts it on his credit card. Well, that represents a liability. He has to pay back the $5 amount that was charged to the credit card. So in this transaction, liabilities will increase by $5. And because this represents another expense, equity will decrease by $5. So both of the impacts are happening on the right side of the accounting equation, but because liabilities are increasing and equity is decreasing, these two amounts offset one another and the accounting equation remains in balance.